Hi, this is Terry Allen of Terry's Tips. Today I'm going to talk about rolling over weekly options. It's a project I do every Friday in several of our portfolios. We'll be looking today at this portfolio we call Wiley Wolf, which trades options on Facebook. So one of our best portfolios. It's one of 8 that we conducted at Terry's Tips. In 2016, Wiley Wolf doubled in value. In 2017, it did even better. In fact, that was the best performing portfolio last year. Started out the year with $3,000 in it, and by November, it was up to over $23,000. And at that point, we took out a little bit over $18,000 and started over again with $5,000. Uh, at that point, anybody who started the year out uh, taken out 6 times as much money as they had put in, and they still had $5,000 left over to go forward. In this portfolio, we use what we call the 10K strategy, which is a series of calendar and diagonal spreads. The short side is these weekly calls, which we roll over every week, usually on Friday, and the long side are calls which have about 6 weeks of remaining life on average. So let's look at the current situation with this portfolio. Um, Facebook today, this is on Friday, the 13th, July 13th. Uh, Facebook is trading at 207.55. It's up 60 something cents for the day. And these are the 2 sets of options that we have that are expiring in a few hours later this afternoon. The stock is barely in the money for the 207 uh, uh, options that were short, the calls that were short. So there's 7 cents of this is intrinsic value, and there's about 50 cents worth of premium it's going to disappear between now and the end of the day. So we have 5 of these things that were short. I don't want to roll these things over quite yet because we've got 50 bucks times 5, $250 we can collect our way until the end of the day. But we may want to do a few things right now, at least decide what we're going to do for the day. If we look ahead, next week we're already short 6 of the 207.5 calls, which are essentially at the money. And I like to start out each week with about half or a third to a half of the short calls that we have that are at the money, which is the 207.5 strike right now. So these 205 strikes, we want to get rid of those because we're going to move those to higher strike prices. So let's just go through what I do. Another unusual thing this week is that we have 2 long positions that are going to expire next week. Typically, that's not the way it goes. These usually have at least 6 weeks of life remaining. But the stock has been going up so rapidly the last couple of weeks that when we roll over each week, we haven't generated a lot of cash because we had to buy back in the money short calls and sell calls that didn't have quite as much premium, so that we weren't generating a lot of cash to roll these things out to longer time periods. But today we'll fix that situation. The first thing we want to do is get rid of this 202.5 July 20 long call. So we'll do that by selling a diagonal spread here. So we're going to sell a diagonal down here, and we're going to change the strike to 202.5. Get rid of that one. Okay, and then we're going to do the same thing here. We're going to sell diagonal spread. We're buying this 205, and we're going to sell. Okay, actually, this could be a calendar spread. We're going to be selling the 205. It's actually a calendar spread. So that leaves us two more of these expiring 205 short calls, and we're going to experiment here. I'm going to sell diagonal. I want to get some out all the way up to 212.5. So, well, 212.5. Just because 2 of these. And usually, when I'm that far out of the money, I go out an extra week, and that's going to put us out to the 27th. And that's an unusual week because uh, Facebook announces earnings during that week, and we're going to collect a fair amount of premium for that. It's not more than that. No, I can understand why that. Okay. So anyway, now we've got these five just at the money calls expiring today, and so we will roll those over to the 210 strike. Let's see what happens. So diagonal. We have to do this 5 times, and we're going to sell 210s. Okay, so let's just see what happened if we made those trades. You look at this risk profile. This shows what the profit or loss will be on these positions 1 week from today, when the next week's weekly options expire. You see, if the stock hasn't changed a bit, we will make about $1,400 in 1 week. Now, this portfolio is worth about $8,500 today, so that's a decent amount. It's close to 15%. And if the stock goes up as much as $3, we make about the same amount, about 15% of the money in a week. Not bad. On the downside, if it falls, it can fall about almost $3 before we lose money on the downside. But since the Facebook goes up, I'm not so worried about that. Particularly going into the weekly preceding the earnings announcement, the stock typically trades up in anticipation of a good earnings report. So I'm pretty happy with this profit graph. On the upside, I am a little concerned. If the stock goes up $5, we make only $500 next week. So I am a little concerned about the upside, but there's something I can do about it because I picked up a lot of cash here today. I've got a clear of $138 there, $200 there. This week here we've got about $700. So we have some cash to add on a new spread or two. So let's go back here again, and so hopefully get some spreads at this 212.5 strike, and we'll do it by going out and oh dear, I can see now we've got long positions in here. This 27 July series. I gotta get rid of those. So we're gonna buy a calendar here. We're gonna go out to August 33rd, which is 6 weeks out, and buy a calendar for the cost of $270. Now this is sort of interesting to look at. I am paying $270 for 6 weeks. Actually, it's 5 weeks of time for these long sides. That's about 60 cents a week. If you look at what we're collecting per week by selling and at the money, this is $2.20 worth of premium. This is over an hour and a half worth of premium. Even if we're way out, 5 weeks, $5 out of the money, we're getting 80 cents, and yet we're only paying 50 cents per week for the 5 weeks that we're buying for a long side. Where you make money in this particular strategy. And here I want to do the same thing. I'm going to buy a calendar to extend the life of these 207.5 calls. 3 of these. And I'll get out through August 31st. Again, with 275, maybe 60 cents per week, less than 60 cents per week. We're going to be collecting well more than that, sometimes over $2 in a single week. And I get 5 chances to collect that $2 by selling it on 1 week premium at the money when I extend the length of this this long position. I'm also going to have enough cash to add on another spread or two, unless I just want to get some. I want to buy a calendar at this higher strike, 212 and a half. I think I got enough money to buy 3 of these. We do have some cash sitting in the account as well right now. It's not being not used. Again, I'll go up to August 31st. And again, that's going to cost us about $2.65 for 5 weeks of time premium. So let's look at what that does to the risk profile graph. Now you can see that if it does go up as high as 212 and a half, 213, we're making $1,300, which is again 15%. And since we're also getting some nice premium by rolling out the long calls that were going to expire on the 27th of July, now they're not going to expire until 5 weeks later, so they're going to be paying a lot slower. So now we're looking at making $2,200 next week at the money on an $8,500 portfolio value. So anyway, I'm now very happy with the looks of this risk profile graph, and I'm going to put this thing to bed, and I'm going to wait to the end of the day to roll out to these positions, so I'm going to end up collecting the extra premium that's going to come our way. Now it's down to somebody down to 35 cents. Stock is up. Now it's up closer to $208. So I may want to. In fact, as soon as I finish this recording, I'm going to roll over the in the money call 205 calls because there's no premium left there. You can see this. A quick way to find out about how much premium is out of these in the money calls is to look at how much premium there is in the 205 puts, and there's essentially none. So it's a good time to roll those things over. So anyway, this is what I do every single week. I create this risk profile, and when I come up with something that looks good, I say, okay, those are the trades I'm going to make this week, and it puts me out of business hopefully until next week, next Friday. The only thing that would change that if the stock were to move rapidly up during the week, then I would probably roll over some of the positions to higher strikes before next Friday. This is exactly what I did last week, and that's why we ended up with 6 of the 207.5 short calls. I rolled out a week early. So that's our story for today, and the process we go through every single Friday.